Welcome back to the European Market Open. A minute to go until the start of cash equities trading for this Monday. Here are your headlines. Janet Yellen says a higher US interest rate environment would be a plus for the Fed and US society. A landmark tax deal, G7 nations agree on a minimum corporate rate of at least 15% and pave the way for levies on multinationals where they operate. And in Germany, Angela Merkel's party won a decisive victory in the final electoral contest before the votes to choose her successor in September, defeating a far-right challenge. Let's take a look at futures then this morning. 15 seconds or so to go until the start of Monday's trading session, the start of another week in markets, of course. And European equity market futures are pretty mixed. Overall, we see a little bit of downside, perhaps. But the Paris market looks as if it could be flat. The German market futures point downwards. The London market futures point to the upside. So a mixed bag, really, as we head towards the start and see the start of the European equity trading session. So the FTSE 100 is open by just 0.1%. So we had anticipated a little bit of a higher move for the FTSE than elsewhere. So we'll see whether that comes to pass. Interesting to watch Reckitt Benckiser. We were talking to Simone Volksman. Asset sales there coming a little earlier maybe than the market had anticipated. So we'll see whether that asset sale makes a big difference. Also keeping an eye on the leisure stocks, although maybe that's a little away from the FTSE 100, more into the FTSE 250 and the smaller caps, because we're asking questions about the June 21st date and whether the UK government or England in particular is going to be sticking to the details around that. Let's see where the other markets have opened then. So we've got Germany's DAX opening to the downside as anticipated, down by 0.2%. The French market also down just a fraction, down 0.1%. The IBEX also a little bit weaker. So we're a little bit sluggish across these European equity markets. US futures also looking fairly sluggish, just down 0.2% on E-mini futures, and Nasdaq futures after the heavy or the strong gains we made during Friday's US session on the back of that non-farm payrolls number. So US Treasury Secretary Janet Yellen says a higher interest rate environment would be a plus for the US and the Federal Reserve. In an interview with Bloomberg News, Yellen said that President Biden should push ahead with his $4 trillion spending plans, even if they trigger inflation that lingers into next year. She says any spurt in prices resulting from the rescue package will fade away, though, next year. Joining us is John Rowe, Legal and General Investment Management, Head of Multi-Asset Funds. John, good to speak to you. Lots to talk to you about then, around where we are on interest rates and that conversation. And I'll start with the comments that we've had here from Janet Yellen. I wonder what messaging you think she's trying to give to the markets. Should we read this as the comments of a former Fed governor, or as Treasury Secretary, or as somebody who's just commenting on what she sees in these markets at this time at face value? How much do we read into these comments from Janet Yellen around a higher interest rate environment? It looks as if we might have a problem with John's microphone, which is unfortunate because we checked it in the break and everything seemed to be working fine. So that is confusing. Let's just have a look at what we've got on these markets for you then, as we see if we can re-establish a connection with John Rowe. We've got the FTSE 100 flat to positive, up by 0.1%. The CAC 40 down, as I say, 0.2%, as is the Xetra DAX. So a little bit of weakness coming through. The Stock 600 down 0.1% or so. Let's give it another go, shall we? John Rowe, I wonder if you can hear me.
I can hear you, yeah. Is that better?
Excellent. Excellent. That is better. Wonderful. So I wondered what you made of the comments by Janet Yellen talking about the positives that come from a higher interest rate environment. What message do you think she's trying to communicate?
I think it's a really strong and positive message to hear from someone with that experience and now still with such a significant role this time in government. I think it's true that if the Fed can create a bit of space on the interest rate policy side, that is a positive. It's got those very extreme positive stimulus measures, which really aren't going to be necessary with the level of stimulus that's coming. Even if you look at the stimulus package that's already passed from Biden, that was nearly 3 times the Congressional Budget Office's guess of the output gap, so the amount of space there is in the US economy. And of course, there's this $4 trillion of potential stimulus still to come. So we're very much in that camp. We think there is a very real chance the Fed comes back into play, even though elements of the inflation are transitory, because they can see that actually they're above target and they've got so much stimulus coming. By the end of this year, we expect the US economy to be about 1.5% above the pre-pandemic trend. And unless the Fed takes action, that will grow to about 3% above trend by the end of 2022. So we expect that pressure to build, and I think that's all she's reflecting. Markets do need to be cognizant that it won't be lower forever.
Okay, and you talk there about monetary policy and how that might be back in play. I guess you take the fiscal plans as we find them, John. But I wonder how concerned you are about the overall level of stimulus that is going to go into the US economy. We heard from Mervyn King, former governor of the Bank of England, of course, talking about global inflation and writing a piece for Bloomberg Opinion saying, make no mistake, the risk of inflation is real. And he cites what he calls excessive stimulus on the fiscal and also on the monetary side. Do you see stimulus levels at the moment as excessive?
So I think it's a very different global position. So if you look at the US specifically, you've got this big build-up in consumer savings, about 10% of GDP sat there on consumers' balance sheets. And on top of that, incomes are higher because of the pandemic, because the unemployment benefits have been so generous. And that money has gone to those with the highest propensity to spend. So specifically on the US, there is a lot of firepower on balance sheets and still a lot of reopening to do. Now, in fairness to Biden, if you actually look at his big tax plan, his big spending plan, a lot of that is back-ended. So actually, with it being in areas like infrastructure, that takes time to come through. If you go back to 2009 and the America Recovery and Reinvestment Act, around 2/3 of that infrastructure money hadn't been spent 18 months later. So actually, this will kind of build as a stimulus. It'll drop in 2022 versus 2021, and then it will build into 2023, 2024. So in fairness, he's away from the kind of sugar rush economics of Donald Trump, and this does feel like he's trying to spread the stimulus out in a more measured way. Elsewhere, the message is very, very different. If you look at Europe, there's nowhere near that kind of level of stimulus.
Okay, that's an interesting point. Let me just stick with the US for a moment because I wanted to get your thoughts on Treasury yields and where we are there. We saw 10-year Treasuries dropping a little bit, the yield, sorry, dropping a little on the back of the non-farm payrolls number as the market changed its assessment of how quick the taper talk was coming, perhaps. But you still expect those yields to go higher then, John. Have you rethought the time horizon based on that NFP number from Friday, or was that broadly in line with what you were expecting?
No, so I mean, it was a big gap down, wasn't it? About 8 basis points on Friday, and clearly that wasn't what we were expecting in terms of market reaction. I think it does show there are a lot of people who are betting on potentially high yields in the future. We're still bought into that narrative. That one number doesn't really change where we see the Fed needing to get to, particularly with the level of pent-up demand on US balance sheets. I think if you do want to look for another risk, and I think one of the reasons we're keen to be short US rates is that we see it's one of the key risks to the global economy. If the Fed does come in, you potentially get a stronger dollar, a tightening of global financial conditions, and that is one of the big risks for this kind of stimulus-heavy global recovery. If you were to say, is there a bigger risk lingering? How do we get to Mervyn King's kind of higher inflationary pressure? It would be the risk of a supply shock on the labour demand side. So the risk that some people who stopped working during the pandemic don't come back, that people reassess work-life balance just a little bit, and that some combination of that kind of squeezes the labour supply, and that could give another source of sustained inflation pressure. So there is quite a lot there, and we wouldn't expect the Fed to just totally look through the next 12 to 18 months of higher inflation prints.
Okay, John, thanks very much. Stay with us. John Rowe, Legal and General Investment Management, Head of Multi-Asset Funds. Thanks very much for starting the conversation with us this morning. Coming up on the programme, the UK's plan to lift the last remaining coronavirus-related restrictions are now in doubt as ministers continue to weigh the threat of a potential fresh wave of the pandemic. We'll think about the impact that could have next. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the European Market Open. 10 minutes into our European trading session, and we've got European equity markets moving to the downside. Stocks Europe 600 down by 0.25%. The FTSE 100 also down, actually, after starting out maybe in slightly better form than some of the other European markets, actually now moving to the downside. Just a quick check on what we've got on leisure stocks. In fact, you've got IWG. This is an operator of flexible office space, down by 15%. That's on the back of an update from that particular business. Not a great time, of course, to be an operator of maybe office space, depending on where it is located, maybe. Let's just have a look at some of the leisure stocks here in the UK. JD Wetherspoon's bucking the trend, ignoring the questions around June 21st, perhaps. Elsewhere, we see a little bit of negativity, but nothing that is much greater, maybe, than the market moves to the downside. Down by around 0.5% on some of those leisure-related businesses here in the UK that could be watching very closely if we do get a pushback on that June 21st date. Let's get a Bloomberg Business Flash for you right now. Here's Juliet Sali.
Anna Qantas has asked Australian authorities for details of a recent intelligence report which suggests it's been infiltrated by organised gangs importing drugs. Local media say the report found as many as 150 of the airline's employees could be linked to organised crime. Qantas calls the claims disturbing and says it follows government vetting procedures. Bloomberg has learned that KKR is close to reaching an agreement to buy Atlantic Aviation from Macquarie Infrastructure. The deal could value the airport services company at about $4.5 billion, including debt. Atlantic Aviation offers hangar space, aircraft maintenance, and other services. Saudi Aramco, the world's biggest energy company, has hired banks to issue its first ever dollar-denominated Islamic bonds. Bloomberg understands Aramco may offer 3 tranches of notes due in 3, 5 and 10 years as it seeks to raise cash to help fund its commitment to pay out $75 billion in dividends. Islamic bonds comply with the region's teachings, including a ban on interest. Well, the founder of China's Walmart grocery chain is set to launch 2 IPOs 3 years after being cleared of financial misconduct. Zhang Wanzhong is seeking as much as $1 billion in a Hong Kong listing for Walmart's operator WM Tech, and he's taking e-commerce platform Dmall public in the US later this year.
I strongly believe this market needs to be consolidated. If you predict that China will have a retailer with 1,000 billion RMB sales, a trillion billion RMB, I will not surprise. It's reasonable. Yeah, it's happening.
And that is your Bloomberg Business Flash. Anna.
Juliet, thank you. Juliet Sarli there in Singapore with the Business Flash. Now, the UK's Health Secretary has said that it's too early to say whether a planned easing of coronavirus restrictions on June the 21st can go ahead. A final easing has been thrown into doubt by the rise of the highly transmissible Delta variant, the one first identified, of course, in India, which is now the dominant strain in the UK. John Rowe, Legal and General Investment Management Head of Multi-Asset Funds, is still with us. Are you looking at reopening risk, John, when it comes to UK assets? I showed a graphic earlier of UK pub stocks, for example, some of them a little bit lower. There's been a lot of talk for quite a while about whether we will see these last remaining COVID restrictions lifted on June 21st.
Yeah, absolutely. And I think because that's already been talked about, it probably makes it less of a big impact if we do get a further delay. Travel and leisure is quite unusual in Europe in that if you look at most cyclical sectors, they're really loved by the market. They come right at the top of what people want to own, things like banks, materials and so on. Travel and leisure is actually in the middle. And that kind of highlights that there's already a little bit of concern that as the laggard of the laggards, it could get caught up in further lockdowns. For the UK specifically, we're long the pound, so I guess you could see some secondary impacts there, but that's much more of a longer-term valuation case where it still looks cheap against both the euro and the dollar. So from that perspective, it might have a short-term impact, but not a longer-term worry.
And in terms of where you're playing the markets at the moment, or where your favourite stories are, John, when you look at the UK, when you look at the EU, both with vaccine rollouts underway, the UK perhaps a little ahead in terms of the percentage of population vaccinated, but Europe talking very positively about reopening agendas and travel possibilities looking greater for those in the EU. How are you playing various parts of Europe at this time?
So the way we look at it is it's great that Europe's now got itself moving. It's vaccinating at over 5% a week. It's looking to vaccinate 75% of the population in full by the end of September. And most of those are these mRNA jabs, so things like the Pfizer and Moderna jab, which is a real positive because they've been shown to be more effective against variants. So while the percentage of the population that's been vaccinated is lower, the efficacy of some of those vaccines is higher. So that's good news. I think the problem in Europe is the question of too little, too late. So they've got the recovery fund coming, $750 billion, 5.5% of GDP, with over half of that being grants. And it's a great move. It's about fiscal unity and joint bonds, and that's a really positive story. It's not too back-ended, so 70% of the money coming out by the end of 2022. But the question is still, is it too little, too late? We're talking about an area where they haven't got close to their mandate on inflation for nearly a decade, and they've still got core CPI below 1%. So what does that mean? Well, it means the core European bit feels pretty boring to us and unattractive. Why? Because there's going to be this big European issuance to back its recovery fund. So we're short OATs, so French bonds, largely off the back of very large supply in that stronger sector. Secondly, higher French debt, nearly 120% debt to GDP now. And so against that backdrop, and only 35 basis points spread to bunds, which is close to the historical tights. It's been hard to stay below 30 basis points historically. Short OATs on the supply story. And then where we really like is Croatia. So Croatia's a big winner from the recovery fund. The grants will be over 10% of GDP. So a stimulus package that's much more like the US in size than the rest of European countries. And against that backdrop, Croatia is on the path to join the euro. So it's in the ERM2 mechanism, where it controls the interest rate versus the euro, and it's a good candidate for early joining. So the earliest people have joined is at just over 2 years, people like Slovenia, Malta, Cyprus, and we think they're on that path. When they do get into the euro, they'll get a multi-notch upgrade and they'll get that institutional ECB support. Now, when you look at Croatian spreads, you still get 130 basis points over bunds in the 10-year, and that's for a country with only about 90% debt to GDP. So it's a lovely convergent story benefiting from that special backing from the Recovery Fund.
That's really interesting. I'm not sure we've talked at such length about Croatia before, so that's an interesting story you bring us, John, this morning. Let me ask you about oil, because I see that energy and basic resource stocks are the worst performing sectors this morning here in Europe, and I'm thinking about oil prices having gone on WTI above $70 a barrel. It's interesting to see, though, that we don't necessarily see investors quickly jumping on that higher oil price and saying that means inflation is heading ever upwards from here. We've got a chart that shows US 10-year yields fairly range-bound, if not moving lower a little, and we've got a chart that shows break-evens having peaked a little before we saw this $70 WTI oil price. How do you draw that higher oil price into the inflation story, John?
So I think when you look at forward oil prices, they're lower, so you've got backwardation in the oil curve. So the market is assuming that at some point, either OPEC plus increase their supply, that in some way US shale comes back, although clearly Joe Biden and the Democrats are going to have a much tighter leash on that industry. And a lot of the tax plans are kind of anti-energy in terms of how he's planning to pay for his stimulus. So I think the reason we managed to get to prices so high is really the Joe Biden effect. It's that the US shale pressure release valve no longer works properly because people are really worried about the environmental restrictions he'll put in place. And we saw more of that in the G7 communication over the weekend. So then it's down to OPEC plus and potentially barrels coming back from Iran to really stabilize the market. And that's what the market is pricing on and relying on, is that even though OPEC plus is being quite careful, this isn't a structural supply-demand imbalance. That's where you get the real spike in oil prices that undermines growth. Somewhat higher oil prices, yes, they matter for inflation expectations, particularly in the US, but they're not too big a concern for sustained inflation. For sustained inflation, you need kind of a wage spiral where expectations and prices get back to each other. And you can't really get that purely through somewhat higher oil prices.
Okay, John, thanks very much for your time today. Good to speak to you. John Rowe, Legal and General Investment Management, Head of Multi-Asset Funds. John will be continuing his conversation with us on Bloomberg Radio at 9 a.m. UK time. Coming up on this program, major cryptos fall over the weekend on the banning of trading accounts on Chinese social media. Some parts of it anyway, but will prices stay down? We'll discuss next. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Welcome back to the European Market Open, 23 minutes into our European trading session for this Monday, and stocks are moving a little bit lower, down by 0.2% on the Stoxx 600. Something else that's been weaker recently has been Bitcoin. The Bitcoin and most other top cryptocurrencies fell over the weekend over worries of further crackdowns by Beijing. Fueling the fire, Chinese social media platform Weibo has suspended some crypto-related accounts. This all comes after Chinese authorities recently cautioned on trading in digital currencies. Joining us now is Bloomberg Market Live's Eddie van der Walt. Good to speak to you, Eddie. So what do you make of the latest Chinese clampdown or crackdown over the weekend?
Very interesting, very interesting. We're definitely seeing signs from out of China that they are not comfortable with the growth in speculation and the growth in adoption of cryptocurrencies. And China is absolutely key to Bitcoin and other cryptocurrencies, given that so much of the mining capacity is there, so much of the exchanges and so much of the trading just happen in China. So this is absolutely crucial for the growth of Bitcoin long term, and it could just be a headwind over the coming months as well.
And it's interesting to see the PBOC working so quickly on a GovCoin, it has other names, but on a sort of government-sanctioned, central bank-issued cryptocurrency. It's interesting that they're working so quickly on that particular agenda at the same time as clamping down here. Is there a sense that the Chinese authorities and governments, and maybe others also, just don't want to see private money taking off to such an extent?
Oh, absolutely. Look, I think there's a lot in cryptocurrencies that the Chinese government will love. For instance, being able to track transactions as they happen, right? In this country, they would love to see that kind of transparency in transactions. But taking money out of the hands of the central bank is just not something that any government anywhere has ever done. And China is not going to be the first to go down that route for sure.
Yeah, there's been a Goldman survey says institutional investors are cautious on Bitcoin. Sometimes you see signs of adoption, don't you, either in the institutional world or corporate world, and then it's met with other signs of ongoing caution. How do you sense that the machinery of finance is positioned when it comes to cryptos at this point?
So there's two really interesting things happening here. I think people are starting to get a bit cautious about Bitcoin. There's a lot of, Elon Musk is tweeting about it, and that moves the price. And that's not really the sort of thing that, that's the sort of risk that's very hard to hedge. At the same time, you've got the environmental risks and so on. But people are getting a lot more excited about Ethereum, right? And over the weekend, even when Bitcoin was down at one point, Ethereum was still up. And we're getting that narrative back that we had in 2016, 2017, where people were saying, I don't like Bitcoin, but I love the blockchain. And people like the technology. But as I say, we also saw this in late 2016, 2017. And that preceded, a long period in which cryptocurrencies did very poorly. So there's some really interesting echoes here.
Yeah, that was certainly the institutional investor mantra, wasn't it, some years back? So we'll see if we do fully return to that then. Eddie, thanks so much. Bloomberg Market Live team, Eddie van der Welt, thanks for joining us this morning. Coming up here on the programme, restaurateur, hospitality entrepreneur Luke Johnson on the future of the UK bakery chain Gales. Plus, we'll get his thoughts on the future of hospitality with the reopening agenda here in the UK. This is Bloomberg.
We've sadly lost 12,000 premises across the sector as a whole. We lost about 330,000 additional staff in terms of headcount through the pandemic. It is a gradual road to recovery, but I am feeling much more optimistic. The positive response we've seen from consumers in returning to eating and drinking out, even outside, has been very welcome. And of course, we're not out of the woods yet, because we know that about 20% will struggle to reopen with social distancing restrictions, and every day that they are closed makes it less likely that they'll be able to reopen. So I think you will see continued business failures within hospitality over the course of the next year. Well, I think the government support has been unprecedented. Equally unprecedented is the hit that hospitality has taken. So we do need the government to look at a solution on rents, which is going to be critical to recovery, a recapitalization strategy to tackle the levels of debt that these businesses are going to come out of the pandemic with. So this government support, fantastic, has allowed us to maintain a large number of staff that we would have undoubtedly lost along the way had we not had furlough. But furlough actually is costing the businesses to implement at the moment, and the costs of staying closed, the industry is burning through £500 million a month in ongoing costs.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European Market Open. Half an hour into our European equity trading session, and the FTSE 100 offering a little brightness this morning, up 0.2%. Elsewhere, we move slightly to the downside, although the DAX pulling back from some of its earlier losses. So we're fairly flat, really, all told, for European equity markets this morning. Let's have a look at the sectors, if you like, and see where we are there. Autos and auto parts to the upside. That's the biggest gaining sector this morning, also probably partly why we are seeing some movement to the upside away from earlier losses over on the German market. And to the upside there, we see Continental is the biggest gainer in that sector, up by 1.6%, of course, a decent weighting over in Germany. In terms of the downside, we've got basic resources and energy moving lower, despite the WTI price taking out $70 a barrel. We're pulling back a little from those prices, and so we see maybe that weighs on energy names. Banks doing well. UniCredit is one of the banks that is doing well this morning, upgraded at Jefferies on a stronger lending recovery. So that is of interest, perhaps. Now, let's get a Bloomberg First Word News update. Here's Juliet Sarli.
And US Treasury Secretary Janet Yellen says slightly higher interest rates would be a plus for society, and that any spurt in prices from President Biden's rescue package will fade away next year. Yellen was speaking to Bloomberg after the G7 meeting in London, which saw a landmark deal on taxation, including a minimum corporate tax rate of at least 15%. Countries also agreed to work towards taxing multinationals where they make money instead of just where they are headquartered. Armin Laschet has boosted his chances of succeeding Angela Merkel as German Chancellor by securing a decisive victory in the country's poorest state. He led the CDU party to 37% of the vote in Saxony-Anhalt, according to projections from public broadcaster ARD. The far-right Alternative for Germany slumped to a distant second in the former communist region with 22%. China's exports continued to surge last month, fueled by strong global demand as more economies around the world open up. Exports grew almost 28% in dollar terms in May from a year earlier, below the pace in April, but still well above historical growth rates. Imports soared 51%, the fastest pace since March 2010, driven by higher commodity prices and last year's low base. An exit poll suggests the party of President Andrés Manuel López Obrador took the lead in Mexico's midterm elections for the lower house of Congress. But the survey suggests AMLO's ruling coalition won't retain the two-thirds majority needed to pass constitutional reforms. Meanwhile, a runoff vote in Peru's presidential election is still too close to call, according to an unofficial quick count. Pedro Castillo, a leftist former school teacher, had 50.2% compared to 49.8% for investor favourite favourite Keiko Fujimori, according to an estimate published by Ipsos. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg, Anna.
Juliet, thanks very much. Juliet Sali there in Singapore with your update there. Let me just get to some breaking news. UK house prices rising by 9.5% from a year ago. That is in the month of May. This is according to the Halifax. In terms of the month-on-month number, house prices rising by 1.3% from April into May. Also, according to Halifax, interesting to see those strong gains, certainly year on year for house prices. Interesting differential in the regional story away from London and other parts of the UK. That's also been part of the narrative recently. And of course, government support to the housing sector has been perhaps crucial in that story. Let's stick with the UK. And the UK's health secretary has said that it's too early to say whether a planned easing of coronavirus restrictions on June the 21st can go ahead. A final easing has been thrown into doubt by the rise of the highly transmissible Delta variant, first identified in India, which is now the dominant strain in the UK. Joining us now is Luke Johnson, partner at Risk Capital Partners, entrepreneur extraordinaire in the hospitality sector. So really great to have you with us. And I know we want to talk about some of your investments and what you're doing with them, Luke. So thanks for joining us. Let me start by getting your take then on the potential for delay for June 21st. How much does that date and what could happen on that date matter for you?
I think it will be a disaster for the sector as a whole if restrictions were maintained, because many outlets can't yet open. Places like theatres, exhibitions can't happen, nightclubs can't open, and most pubs and restaurants and cafes can't trade at even break even, given the social distancing restrictions currently in place. So I do think, given the very low levels of deaths and hospitalizations and the great success of vaccination, all restrictions should go on the 21st of June as promised.
So just because we see hospitality venues open then, Luke, we shouldn't assume that they're doing okay with the conditions that they're operating under at the moment. Do you think that many will be operating, at a loss because of the regulations that currently exist?
Definitely, yes. I would say a majority are either not actually trading already, and a lot are still not open, or are trading at a loss. And therefore, it's completely unsustainable. And we also have, at the end of this month, the deadline of the lifting of the moratorium from landlords taking action against tenants who haven't paid rent. And that is another cliff edge that the industry faces that needs government intervention.
You say that the measures should be lifted as promised. I mean, was it really promised, Luke? Does the hospitality sector think that it was promised, this reopening on June 21st? Because I think the government has always said, no earlier than, and that perhaps is the language they might fall back on again if they do, and we don't know, but if they do have to delay things.
Well, they said data, not dates, and the data is so much better than predicted by any of the projections of the models. It seems to me the data has proved that the vaccinations have worked and the pandemic is over, and therefore we should get our lives back, because I think the harms, the collateral damage, not just economic, but other harms to things like education, for example, from lockdowns and restrictions need to end.
And which parts of hospitality do you think are struggling most still, Luke? Is it pubs where, they're having to pay for table service? Is it restaurants that are operating under capacity, at lower capacity? Where is the pain the greatest?
Well, the pain is the greatest in things like nightclubs and festivals and concert venues, because they're all essentially shut or not happening. Essentially dancing has been illegal for the first time for about 500 years for 15 months. And it seems to me it's a madhouse where you can't dance and sing. And we need to get things in proportion and realize that so many more people are dying every single day from other diseases than from COVID, that we need to return to reality rather than this obsessional focus on a single disease.
Yeah, I mean, I know there are many domestic locations where dancing has not been banned, Luke. Kitchen discos continue aplenty, but I completely take the more serious point you're making.
Not quite the same thing, is it?
It is not quite the same thing, absolutely. Let me ask you about Gales then, this bakery chain. How have you managed to weather the storm, and in what state is this business as you come to restart the sale process for it?
Well, the retail business is trading very well. We have had a roller coaster of the 15 months, so that we did early on in the pandemic shut a number of our outlets, but we then reopened them pretty quickly. We pivoted to takeaway only. We obviously now have eat-in as well, but we've also opened a number of new branches over the last year or so very successfully. We have a great pipeline of new openings, and so the core retail business is doing extremely well. The wholesale business, which supplies food service industry like restaurants, pubs and hotels, has struggled, and it's been shut for much of the last 15 months. It's now reopening alongside the industry. But I can tell you now, from the volumes we're seeing there, the sector is still trading way below what it was in 2019. And therefore, that's why restrictions need to end. As a whole, the group that owns Gales, which is called Bread Holdings, is doing well. And I think that's partly because our outlets are in neighbourhoods where people live rather than in city centres where people work.
Something of a suburban renaissance with the work from home phenomenon of the past 12 months then. Luke, thanks so much for joining us. Good to get your perspective today. Luke Johnson, partner at Risk Capital Partners. Coming up here on this programme, a landmark tax deal. G7 nations agreed to a revamp of the rules, making it easier to tax big tech giants. We'll discuss the detail next. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Welcome back to the European Market Open. 42 minutes into our European trading session, and Monday's session looks fairly flat, all in all, not going anywhere in a hurry. Despite some negativity at the start of the trading day, we seem to have recovered our poise just a little. US futures, though, still point downwards. The Nasdaq futures down by 0.3% after strong gains, though, on Friday's session. Now, G7 nations have agreed to revamp their tax rules, including a minimum corporate tax rate of at least 15%. The landmark deal could help countries collect more revenue from big digital firms. So there are a number of strands to what has been agreed by the G7. For more, let's bring in our Brussels correspondent, Maria Tadeo, who's got the details. Maria, what exactly has been agreed here?
Yes, Anna, look, this is being hailed as this new tax revolution. It's a new taxation system for the 21st century. You talked about this minimum tax that will be around 15%, but also, and perhaps more crucially, is this idea that governments will now be able to tax some of the sales and services from digital companies in the countries where they're being made. So a lot of the criticism in the past years, as you know, had been that a lot of these companies were flipping profits from one place to another where the tax jurisdiction was lower. Now, Anna, all of this, of course, sounds great on paper. The problem here, perhaps, will be the implementation. This is not going to be easy. We're talking about the G7, but there will need to be an agreement at the G20 and, of course, the OECD too. So this could take some time. Now, what is interesting, however, is that over the weekend, we did hear from some of the companies affected by this, Facebook, Amazon, and they said that to some extent they would welcome the move if that allows to have just one tax across the world. It would make it easier for companies instead of very different national regimes.
Maria, thanks very much. Our Brussels correspondent, Maria Tadeo, joining us there. Let's take this conversation further. Tim Starson, KPMG Value Chain Management Partner, joins us now. Tim, nice to speak to you then this morning on the European Market Open. Let's take a few of these things in turn. Let's start with the minimum corporate tax. 15% is it seems to be the number that they've agreed, although some voices suggest they want it to go higher. We still need to get G20 agreement then, and then maybe this goes back to the OECD, some 140 countries maybe in conversation there. I mean, how many countries would need to sign up for this for it to have the desired impact? If the desired impact is to make sure that many more businesses pay the corporate tax rates that governments intended them to?
I think firstly, most countries will sign up to this. So where the G7 goes, the G20 is probably going to follow, because I can't really think of any members of the G20 who would not be in favour of this sort of change of direction. Where the G20 goes, well, they delegated the programme, the details of this, to the OECD. Most OECD members will sign up. Actually, the way that this so-called Pillar 2, so this global minimum tax, is set, you don't have to have every country sign up for it to work, because there are two ways that this works. First of all, if you're the parent company jurisdiction of a group that is paying tax at a lower than 15% rate, then you can collect that top-up tax. But if the parent company jurisdiction isn't one of those countries that signed up, they've opted out, let's say it's a tax haven somewhere, then other countries, if they have subsidiaries that are paying one of those low tax companies, then they can collect the tax too. So it's actually quite hard to get out of, and you won't need 100% consensus to make this work.
That's actually really interesting then. So that answers questions about whether there'll be certain tax havens that would be able to sort of live on as that after this. So that's interesting, Tim. Let me ask you about the ability to tax, maybe tax revenues, or however this is in the end worked out, but the ability to tax businesses in the locations where they operate rather than where their headquarters are for profit purposes. This has been something, this is the other pillar that the OECD has been working on for some time. And I was looking at the wording, and I wondered if you could help us understand what it means. It says countries where big firms operate would get the right to tax at least 20% of profits exceeding a 10% margin. So what does that mean? For example, France's ability to tax Google, or Germany's ability to tax any other tech name. I mean, how is this going to work?
Okay, first of all, it's not just tech companies. So I know this was targeted to try to deal with a concern around what tech companies were doing, but this is potentially a lot wider. However, it is for the biggest companies in the world, and companies that have more than a 10% profit margin. So although there's been talk about 100 companies, I suspect it'll be a bit more than that, but this isn't everyone. How this is going to work, this is really about kind of turning corporation tax, which has been about profit in the past, into something that's sort of partly about profit, but it's partly about sales. And it's shifting where you pay your tax to where your customers are, rather than where the people who come up with the decisions, the innovations that drive your firm. It's where your customers are. The mechanics of this, I'll try to keep this quite simple. If globally you're earning more than a 10% profit margin, bear in mind all of this is subject to the details and to what finally gets agreed. Then anything over and above that, calculated on a global basis, goes into a pot. And that pot is allocated out in a different way from how profit is allocated under what we call our transfer pricing rules, our normal rules. So that extra is sort of floating profit, which can then be allocated essentially based on an allocation key around your customer base, the size of your market. So if you're a country that has lots of customers that are driving sales and therefore profit for one of these multinationals, then you get to win. And the countries that didn't have a big customer base but might have had, for example, a lot of R&D going on, a lot of headquarter decision making, they're the relative losers.
Okay, that's a really good explanation, Tim. So thank you for that. Do you think that then countries that have imposed, I take on board what you said about this isn't just tech, and but we have heard, for example, from Japan's ASO saying that most of the 100 firms, in his view at least, would be US based. We have to see. There could be some big European names in there as well, maybe some other Japanese names. We'll see how they define these top 100. But given what you've said there, what is the impact going to be on companies that fall into that bracket? How big a change is this going to be? How revolutionary is this going to be for those businesses?
My personal view, not very revolutionary. So for a start, as we said, this is quite a small number of companies. They already assess profits and pay tax in the jurisdictions where they have major sales. Actually, some of the more sort of fully fledged tax planning structures that were around before the so-called BEPS 1 project a few years ago, most of them have gone, particularly with the US tech giants. So they're already paying tax in those countries. This shifts things around a bit, but not massively. I actually think the global minimum tax is probably the more radical of the two solutions. It's certainly the one that's going to have a wider impact too. What it will mean, of course, is that their in-house tax teams and their advisors are going to have lots more calculations to do, and there will be lots more arguments amongst tax authorities as well, because there's judgment calls involved in this too. So it's not quite so straightforward. You'll still see arguments between country A and country B about who gets what share of the pie.
Yes, that pot of global floating profits, as you described them, and the allocation key that allocates those globally. That could be interesting to watch then. Tim, thanks very much for joining us. Tim Sarson, KPMG Value Chain Management Partner. Thanks for your time. Coming up here on this programme, we get back to the markets on a choppy day for stocks, weighed down by miners and oil names, those two sectors weighing down the stock 600, but we're fairly flat overall. This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Welcome back to the European Market Open. 53 minutes into that European Market Open, and stocks overall not heading anywhere. US equity market futures look a little sluggish as well, down 0.3% on NASDAQ futures. Ven Ram from our Markets Live team is with us to close out this hour. Ven, very nice to speak to you this Monday morning. What did you make of the comments by Janet Yellen around a higher rates environment and what that would mean for the US economy? What do you think she was trying to communicate?
Morning, Anna. I think Ellen's comments are an acknowledgement that kindling inflation that is too low is as big a problem, if not a bigger problem, than subduing high inflation. Since the global financial crisis, central banks have been yearning to see some semblance of inflation. In the Eurozone especially, as we know, they've thrown pretty much everything they've got to stoke inflation, with negative interest rates, extraordinary stimulus in the form of bond purchases and what have you, but we still don't have any inflation, meaningful inflation to speak of. So Yellen's comments must be viewed against that backdrop, and coming from one of the biggest doubts in monetary policy history, that's something.
That's interesting. Do you think that is weighing on markets at all, or are we just... are we seeing US futures a little bit weaker because of the strong rally we saw on the back of the non-farm payrolls number on Friday?
I think the response is kind of tepid, to be honest. If you look at the 10-year rates across, or even the entire yield curve across the sovereign markets, G10 markets this morning, we are ticking a bit higher in terms of rates, but not a whole lot higher. So I'm not too sure those Yellen's comments are kind of, definitely they are one of the factors that traders are looking at, but I don't think it's kind of moved the argument for a taper talk anytime soon. Anna?
Yeah, let me think about a different jurisdiction, or take us on to a different jurisdiction, Ven, and that is the ECB. We have an ECB meeting this week. Is this going to be one to remember, or one that will fade into the background?
I think it's going to be one that will fade into the background. A couple of weeks ago, it was going to be one of the bigger events, but unfortunately, it's kind of pretty much every ECB speaker since about May 20th has begun pouring cold water on the suggestion of whether the ECB will announce any reduction in its bond purchases. That is the big question that was on everyone's mind. But if one were to parse their comments, what they're essentially saying is, we want the recovery to take a firm hold. We are not too concerned about those inflation expectations, and we are not going to reduce our pace of bond buying. That essentially means that this is one of those ECB meetings that will quickly fade out of our memory.
Okay, Ven, thanks very much. Thanks for the heads up. Ven Ram from our Markets Live team, thanks for bringing us thoughts this Monday morning. That is it for the European equity markets then. Not going anywhere in a hurry, it seems, this morning. Fairly flat. The FTSE 100 up 0.2% despite the weakness, the weight being applied by energy stocks and basic resource stocks. We do see some movement to the upside on the FTSE 100. Elsewhere, things a little bit more in the red. NASDAQ futures, as I say, point downwards. E-mini futures down by 0.2%. All that, of course, in the context of gains made during Friday's session. That is it for us. This is Bloomberg.
There's no, hardwired deadline. We are doing the work of legislating. This is a big week.
It is a relationship in trade that has been marked by significant imbalance. That is in terms of performance, but also in terms of opportunity.
If you own a Bitcoin today, you will be a millionaire in the future, for sure. Congratulations.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning and welcome to Bloomberg Surveillance, the Early Edition on this Monday, the 7th of June. I'm Francine Lacqua here in London, and here's what's coming up on today's program. G7 nations agree a minimum corporate tax of at least 15% in a landmark deal that could see governments outside the U.S. impose levies on tech giants such as Facebook and Amazon. Treasury Secretary Janet Yellen says higher rates in the U.S. would be a plus for both the Federal Reserve and the nation as a whole. And NatWest Chairman Howard Davies joins the program shortly as Boris Johnson and Rishi Sunak summon UK finance chiefs to discuss their role in the post-pandemic recovery. So let's get straight to our top story. G7 nations have agreed to revamp their tax rules, including a minimum corporate tax rate of at least 15% on foreign earnings. Now, the landmark deal may help countries collect more revenue from big digital firms.
The G7 has taken significant steps this weekend to end the existing harmful dynamic, making commitments today that provide tremendous momentum towards achieving a robust global minimum tax at a rate of at least 15%.
I think the crucial thing for people to take away is the principle of fairness. That's what we've achieved today to ensure that there's a level playing field for all types of companies. And whether it's people operating in tax havens or it's digital companies, we're going to level the playing field and inject that principle of fairness into our global tax system.
Well, that was U.S. Treasury Secretary Janet Yellen and UK Chancellor Rishi Sunak. Now, joining us is our chief Asia economics correspondent, Enda Kearns. Enda, how important is this deal and what does it actually mean?
Well, clearly, Francine, look, it's a big step forward in this debate. It's been going on for quite a while now. On the one hand, it's an agreement to tax these, especially these big technology companies, on where they earn their money, not just where they're based. And of course, it will help pay for the pandemic. Let's not forget that governments have borrowed over 20 trillion since the pandemic began. So that whole borrowing binge has accelerated the need for this tax agreement in the first place. It's an example of a multilateral agreement. We haven't had one on this scale for some time, and you see how the technology companies are reacting to it. They're giving it a kind of a cautious welcome, so to speak. So I think by all accounts, there's no doubt it is a step forward. It is a big bringing together of the world's richest economies, but clearly there's still a way to go, Francine, before this does get across the finishing line.
So what comes next in the process, Enda?
Well, I think this is now where the devil gets into the details, so to speak. We know that there's a broad push for this now. There's a broad consensus for it, but there's still some detail to be worked out around what level exactly. I mean, France is still talking, for example, about a higher level. There is the issue of getting it ratified at national parliaments. There's some opposition on both sides of the aisle in the US. For example, we have the G20 finance ministers meeting coming up this month. That will be one to watch because that's, of course, a broader audience than the G7. Then you push into the OECD track. So there's certainly a way to go yet in terms of getting all of these governments on board and getting all of the details signed off. And then, of course, implementation itself will take years. But to be clear, Francina, at the very start, there has to be said, it is a significant agreement, and it is a coming together of governments on a major economic issue, the likes of which that we haven't seen now for some time.
And thank you so much, our Chief Asia Economics Correspondent there, Enda Curran. Now let's also talk about inflation, because the Treasury Secretary, Janet Yellen, has weighed in once again on the inflation debate. Now, speaking in an interview with Bloomberg, she said President Biden should push forward with his spending plan if they trigger inflation that persists into next year and forces rate hikes, which would be good for both society and the Fed. The former Bank of England governor, though, Mervyn King, writes in his column for Bloomberg Opinion this morning that the risk of inflation is real. He says we can't know if inflation will rise over the next few months or a few years, but the prospect should actually make us nervous. Well, joining us now to talk about inflation, tax, and much more is Sir Howard Davies. He's NatWest Group Chairman, a former Deputy Governor of the Bank of England, as well as the Director of the London School of Economics. He was also the first Chairman of the Financial Services Authority. So, Sir Howard, thanks so much, as always, for making us a little bit smarter on all these global issues. First of all, there was a landmark deal on tax. Does that actually change the way that countries will operate amongst each other and companies really taxed, or are there going to be processes that make it much more difficult than it looks on paper?
Well, your correspondent was right that there's quite a bit of work to be done since after this agreement, because the G7 is, 7, and there are plenty of other countries out there. Now, you may assume that with some of the biggest other countries, they've probably done some pre-cooking of this. But it will be hard to get it through both in Europe and more broadly, because there are some countries, Ireland being one, which have made considerable play of their low tax environment. And that's going to be a bigger change for them than it is for the UK. So there is quite a lot of work to be done. But it is significant that the US have been prepared to do this deal or to announce this deal, because in the past they've not been prepared really to exert themselves on international tax questions. So that's the biggest, most significant change, I think.
When you look at inflation, I don't know how much we should worry about inflation now. And it goes to the big debate, Sir Howard, of the people like Janet Yellen that say, look, this is transitory because of the pandemic. And then the critics that I guess worry that because of this infrastructure plan and this huge spending from the US and elsewhere, we're going to have, fast rising inflation that's here to stay.
Yeah, I think the US are being a bit confusing here. And I think it would be good if we heard one message from the US, because on the one hand, you've got Janet Yellen actually saying, well, maybe a rise in interest rates would be a good thing. And as a banker, I could hardly disagree with that. That would actually be quite positive from a bank's point of view. On the other hand, you've got the Fed saying, well, we are going in future to adopt an average inflation approach, whereby if there is an undershoot of our 2% inflation target for a period, then we will compensate for that by allowing inflation to be above the target for a period. The difficulty is that they haven't said when the period starts. How far back do you go in looking at what past inflation has been? But in fact, if you think that through, it's not the same as what Janet Yellen is saying, because what the Fed is saying is we may not raise rates and allow inflation to be higher than the target for a period, whereas she's saying, well, higher rates might be a good thing. So I do think this is a bit confusing for the market at the moment, and it would be quite good if we had one consistent message from the US.
But Sir Howard, is it maybe then a message from Secretary Yellen saying actually, the Biden administration will stick to the $4 trillion spending plan no matter what happens?
Well, the trouble is it's slightly back to front, because it's normally the Fed who talk about interest rates and the Treasury who talk about spending. And now you've got the Treasury giving an interest rate forecast, which, as you know, Francine, in Europe and in the UK would absolutely not be done. I mean, there'd be huge alarm if Rishi Sunak started talking about interest rate policy, or indeed, Macron started talking about interest rate policy, because those are central bank things. So there's a confusion about who's saying what and why, and I find that rather difficult.
Sir Howard, how do you see the recovery taking shape? Is it going to be a stronger recovery than we thought, or are we getting ahead of ourselves and crying victory?
I am quite bullish at the moment from what we are seeing at the bank and from what the Bank of England are saying. I think that we can expect that quite a lot of the spending that was foregone last year will now come through quite quickly. Now, it'll be largely consumer spending, but the Bank of England estimate that people have saved about 10% of their total annual expenditure. And if they only spend half of that in the next 6 to 9 months, that's a big boost to consumer spending. So in the short run, I am quite optimistic about the bounce back. And you can see indications of that in the housing market. You can see it in the labour market with vacancies rising. The bigger question is where we settle after that, because what we found in the last global financial crisis was that we did have a bounce back, but then we settled back to a trend growth rate which was lower than the one we went into the crisis with. So the bigger question, I think, is will we come out of this and start to grow more rapidly on a consistent basis after this immediate bounce back? And the trouble there is that we haven't seen investment rise yet, because that's been the key failing, I think, particularly in the UK, but elsewhere as well, that investment has been relatively weak. And unless investment picks up, it's hard to see why we would end up with a sustainable growth rate that's higher than we went in. So I'm, optimistic in the short run and a bit cautious in the medium term.
And so why do you think that investment hasn't picked up, Sir Howard? Is it, chief executives being especially cautious because of variants and I guess the uncertainty of further lockdowns, or is it something deeper?
I think it's something deeper, because it is something that's been persisting now for quite some time. The UK has had a lower investment rate than any other G7 country for a decade. So it's not just a COVID point, nor is it just a Brexit point. I mean, some people have said, well, it's post-Brexit investment has been weaker, but it seems to date back further than that. It just seems that somehow the domestic companies in particular, because inward investment's been relatively strong, are not disposed to invest. They're not confident about the profile of demand in the future. And that's the problem that we face in the UK. And so far, we haven't cracked that.
Sir Howard, thanks so much. Howard Davies there of NatWest Group stays with us, and we'll talk a little bit more about actually the UK situation and banks as well. Now, coming up, Boris Johnson and Rishi Sunak summoned the UK's top finance chiefs for a discussion about the City of London's role in financing the pandemic recovery. As ministers cast doubt over the country's planned reopening, we'll have a full conversation with Sir Howard about that. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
The power of Bloomberg. First on news.
Headlines crossing from Morgan Stanley. It's a management shake-up, planning for transition in 3 years potentially.
This is a huge move over at JP Morgan. It is a shock, of course, to the market.
First on earnings.
Apple, a big beat, well ahead of the 33% increase in revenue.
First on markets.
The capitulation phase is buy.
The power of the Bloomberg terminal. The power of Bloomberg television and radio. Bloomberg has it covered.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the UK's finance chiefs will sit down today with the Prime Minister Boris Johnson and Chancellor Rishi Sunak as the government seeks assurances about the sector's commitment to financing the post-pandemic recovery. Now, this as government ministers threw doubt over the weekend on England's reopening date of June 21st. Now, more than a dozen bankers, including Barclays Chief Executive, the LAC Chief Executive, and NatWest Group Chief Executive, will attend the meeting. Executives are also set to discuss how best to maintain the UK's competitiveness in fintech and the burgeoning green finance industry. Well, we're back with Sir Howard Davies of NatWest Group, who's still with us. Sir Howard, thank you so much for staying with us. So, first of all, when you look at the relationship between the government and the banks, how's it going? It seems that, you know, very different to 08, the bankers are now seen as part of the solution to the recovery.
Yes, the government has said that, which is nice. And so, yeah, I think there is a collaborative relationship at the moment, and there aren't really any main huge issues. I mean, the government are consulting on the bank tax surcharge, and you won't be surprised to know that I think that should be reduced. But the fact that they're consulting on it is positive in itself. There aren't really any huge issues with the Bank of England on regulation at this point. The bank have changed their view on dividends, so we're allowed to pay dividends again. So whereas 12 months ago, I think I'd have listed a litany of issues where we were somewhat not at one exactly with the government and the bank, that's not really the case. The big issue now, of course, is financing the recovery. I don't think there's a big issue on the personal side because, as we've just been saying, individuals have saved a lot of money, so they've got money to spend. On the corporate side, you know, we're ready to lend. The issue, again, as I've been explaining, is whether there'll be enough investment demand. So I think that's the big question. How can we get investment demand moving?
Sir Howard, what exactly is the main message from NatWest to the government? So I know there's a number of questions from the Chancellor, including, you know, fintech, green finance. What do you want to make sure that authorities listen to?
Well, I think that our position is probably be the same as many other businesses, which is that we think that an environment of some predictability is important, and therefore that people should have a clear view of a kind of roadmap to reopening, and recognizing that things can change, what would need to change in order for that roadmap to be amended. I think that kind of certainty, not absolute guaranteed certainty that things will open at a particular time, because we understand that's unrealistic, but an understanding of what the factors are and what makes the decisions about whether things get opened or not. And as you've heard, the travel industry is not happy that those decisions have been particularly transparent in the past. So some certainty is required. I think also from a finance side, you know, we would like to see there's signs that the government has a plan to deal with its excess debt over a period, not in the short term. I don't think that's appropriate now. But how will taxes be adjusted in the future? And just corporation tax doesn't seem to me to be a likely solution for the long run. So the government's going to have to find some way of replacing fuel duty, which is clearly declining, and some way of balancing the books. So some certainty there as well is helpful. But I don't think this is a moment at which, you know, the government and the banks are at loggerheads on any big issues. This is a free and open discussion about just how best to finance the recovery that we all want to see.
And so, Howard, when you look at actually the, you know, Brexit and London, how can London remain competitive?
Well, yes. I mean, my view is that London still has a very important role to play in financing Europe, but largely as its offshore centre now, rather than a purely onshore centre in Europe, which is what we've been for the last 20 years or so. Now, the individual industries, sectors of finance will have particular shopping lists. The insurance industry, for example, would like to see some reforms to Solvency II. The banking sector is not demanding a lot because, of course, much banking regulation is in fact global, not European. You know, the main rules on bank capital, which are the most important thing for banks, emerged from the Basel Committee. The European Union is represented there, but so are we, so we always have been. So I don't think that it's an issue there where you say we leave Europe and therefore we change our bank capital regime, because our bank capital regime is a global regime. So I think it's more in the areas of the stock market. There have been some proposals for making listings easier in insurance, for Solvency II, where it is possible to consider some changes in the UK which are different from the ones we have in Europe. But on bank capital, which is the most important thing for banks, it's global. So there's no point in trying to pretend that you can gain some advantage in Europe by changing it.
Wonderful. Thank you so much for all of your insight. Sir Howard Davies there, NatWest Group Chairman. Now, coming up a little bit later on Bloomberg TV, after G7 nations agree a landmark tax deal, we'll speak to the OECD Secretary General. He's Matthias Cormann. That's coming up shortly. And this is Bloomberg.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The UK Health Secretary, Matt Hancock, says it's too early to say whether a planned easing of coronavirus restrictions on June the 21st can go ahead. Ministers are continuing to weigh the threat posed by the rise of the Delta variant, first identified in India. The government says the variant is about 40% more transmissible than the previous dominant strain. Now to Germany. Armin Laschet has boosted his chances of succeeding Angela Merkel as Chancellor by securing a decisive victory in the country's poorest state. He led the CDU party to 37% of the vote in Saxony-Anhalt, according to projections from public broadcaster ARD. The far-right alternative for Germany slumped to a distant second in the former communist region with 22%. China's exports continued to surge last month, fueled by strong global demand as more economies around the world open up. Exports grew almost 28% in dollar terms in May from a year earlier, below the pace in April, but still well above historical growth rates. Imports soared 51%, the fastest pace since March, driven by higher commodity prices and last year's low base. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. A lot going on in the markets. Actually, it's going to be a big week because, of course, it's ECB, and then we had that landmark deal in London over the weekend for a tax. So we look at some of course, the companies that this could affect. It's mainly the big tech companies. And then overall, we're just waiting for more news on inflation, the tax plan, of course, in view, the dollar ticking up. You can see in general, U.S. equity futures dropping, a little bit of pressure also on some of the European equities as well. Coming up, more on the tax deal.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can
can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
G7 nations agree a minimum corporate tax of at least 15% in the landmark deal. NatWest chairman Howard Davies tells this program that it will be hard to implement beyond the group of 7. Treasury Secretary Janet Yellen says higher rates in the U.S. would be a plus for both the Federal Reserve and the nation as a whole. And Angela Merkel's party wins a decisive victory in the final electoral contest before her successor is chosen in September. Well, good morning, everyone. Happy Monday. First of all, it is Monday, and we have a packed week ahead. I'm Francine Lacqua here in London, and welcome to Bloomberg Surveillance Early Edition on this Monday, the 7th of June. Now, G7 nations have agreed to revamp their tax rules, including a minimum corporate tax rate of at least 15% on foreign earnings. The landmark deal may help countries collect more revenue from big digital firms. Well, the NatWest chairman told us earlier that the plan will be hard to implement before or beyond the group of 7. Well, joining us now from Brussels is our Brussels correspondent, Maria Tadeo. Maria, great to speak to you on this Monday morning. So what are the details on the deal exactly?
Yes, Francine. So this is now being hailed this morning as this new taxation, this tax revolution for the 21st century. Of course, a lot of this has to do with the digital companies. There's an agreement, as you said, on the rate that's at least 15%, but also the idea that companies now will have to pay in the countries where they make their money or they sell their services. For a long time now, there had been criticism that they were kind of shifting and flipping profits to low tax jurisdictions. This would avoid that. But Francine, going back to what you said, you know, the implementation risk of this remains very high. You know, this was an agreement by the G7. This will have to go to the G20 and ultimately also go to the OECD. And you can expect that there will be pushback from countries that are competitive on the taxation and want to remain to continue to be so. So again, it's not very clear that this will happen overnight.
So what's been the reaction from some of these big firms, big tech firms, that will eventually have to pay more tax, Maria?
Yes, and you know, Francine, it's interesting that we did get reaction. It was very quick, and it was also more positive than you would expect. Now, we heard from Facebook and Amazon. They said that they welcome the clarity around it, that they welcome the fact that there could be a single tax internationally that is recognized by all countries and all different companies. For them, I would argue, over the past few years, there has been this coming to terms with the idea that they will have to pay more, in particular in Europe. And, you know, they're now coming to terms with that. It's more about the clarity on the rate and who gets to tax what. If that means that there is a global consensus for them, it's a move that they would prefer over many different national regimes.
Thank you so much, Maria Tadeo, there in Brussels for us. Now, we're just also getting some breaking news, and this is 220 million euros that have been Google has been fined $220 million actually euros. I'm getting all muddled up between the dollars and the euros, but in my calculation, 220 million euros is equivalent to $268 million. So it all adds up. So they're paying now 220 million euros to settle France's probe of Google's abuse of power in online advertisement. This is after the French authorities put on this antitrust case over online advertising. They seem to have settled, and that's the fine, 220 million euros. Now, joining us to talk about the latest on the markets, to talk about Bitcoin, of course, futures and everything in between, is Eddie van der Veld. Eddie, you survived the CFA, which is good news. Now it's the wait to see whether you get it, but congratulations on that, because I know it's been a long slog and we've missed you on TV.
Congratulations after the results come. Let's wait. Let's not get carried away. So,
well, you're still in one piece, Eddie.
I'm not
so
counting any chickens just yet. So,
Eddie,
listen, no, but it's great to be back. So, Yeah, markets. I mean, Europe had a really interesting start. We saw this this lurch lower in European markets early on, and that was quickly erased. Some of that was on oil prices, but I think there's just a little bit of uncertainty about what these tax changes are going to mean, and people are just trying to price in, exactly what to do around these things. Some of this has been a long time coming, but I also think there was a lot of people that didn't expect the breakthrough at this moment in time.
So, Eddie, I mean, let's talk about crypto, because it's been pretty wild. And, I've been dying really to get your thoughts on everything from Ether to Doge to kind of the Elon Musk tweets. But is this still, becoming mainstream, or because of all the volatility, like literally by tweet, do you think asset managers are slowly shying away or taking a pause for breath?
There was something really interesting that happened over the weekend. We saw Bitcoin fall substantially, on this pressure out of China, which seems relentless at the moment. But at the same time, you saw Ether hold up fairly well through most of it, right? And I think what we're seeing from the fund managers is we're seeing a little bit of a repeat of 2016, 2017, where people are saying, look, I don't really think Bitcoin's going to replace the dollar, but I do like the blockchain technology. And Ether seems to be the leader in that. Ether seems to be able to adapt quicker than Bitcoin. And a part of that is just because Bitcoin is not, it's still treated as a kind of quasi-religious. Its early texts, the white paper and the Satoshi Nakamoto, who's absent, makes it very hard for the cryptocurrency to change as change is needed. And technology comes with change, and I think this is giving Ether the edge. And so I think, but I do worry about this echo of 2016, 2017, where everybody's saying it's not Bitcoin, it's the blockchain, and that's what we saw just before the collapse last time.
Eddie, a lot of the focus today, of course, is on what Janet Yellen said about inflation. Now, we had a good conversation, actually, with Sir Howard Davies that was saying, the message from the U.S. is confusing because this is the finance minister now talking about rates going up. And we tried to, figure out whether this was just a signal that the Biden administration, no matter what happens with inflation, will stick to the plan. But actually, how the markets take this, it's once again, Secretary Yellen kind of maybe going into territory that she shouldn't be waging on.
Absolutely, and I think it's a very dangerous situation in the US. If you've got this sort of two-headed dragon where people still put a lot of stock in what Yellen says, and she's obviously speaking on behalf of the administration, but she's not speaking on behalf of the central bank. So you don't want to see any differences between the two. And the previous time that Yellen spoke, of course, on inflation, that was we saw markets really move on that. So I think this is a worry for markets, but it is also just an admission that the grown-ups in the US know that inflation is coming and that it's maybe transitory, but at the same time we are seeing the wage pressure coming through, and that's not the same as higher oil prices. This is something that can be sustainable. So therefore, I think she's probably just stating the obvious that at some point, inflation is picking up, and at some point that might mean higher rates.
Eddie, I know what you're also exceptionally good at is finding things in the markets that, will play out in the next couple of weeks that no one else has really seen. So are you looking at commodities? Is there another space? Is it currencies? Is there another space in the market that is of exceptional value right now?
That's the biggest compliment you've ever given me, Francine. Thank you. I don't know if that I can.
Yeah, don't let it get to your head. You still have to pass.
I'll tell you one thing that I am looking at very closely is this inflation narrative, and particularly the food inflation. If that's starting to hit emerging markets who are struggling still, with bringing COVID under control, just as they start.
Good morning, traders. Are you ready to trade today? I'm going to place an order to sell short euro at 121.57.6. So you still have time. If you would like to trade today euro against United States dollar, here is your chance. Please place your order and copy this order and trade. Stay with me, and we'll go through until the end of this trading session and until the end of trade. If you want to register for webinar, please do so. We still have places available on Wednesday. For our strategy, please go to company.co.uk and you will get the strategy. Okay, as soon as it will get filled, I'll tell you what we're going to do. Okay, I'll speak to you later, guys. Okay, guys, position opened on euro. Stay with me. We will guide you through because we trade this position with real money and nobody wants to lose money and we never lose money. We're trading for over 30 years right now and we never lost any money because we know how we trade, we know our strategy, and we're always following the strategy. Okay, I'll speak to you later. Well done, guys, all of you who decided to follow this trade. If you still want to enter this trade, you still have chance because it went up. So stay with me and place an order to sell short euro. Okay, I'll speak to you later, guys, and stay safe.
Never sleep. So stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
The G7 is, seven, and there are plenty of other countries out there. Now, you may assume that with some of the biggest other countries, they've probably done some pre-cooking of this, but it will be hard to get it through both in Europe and more broadly, because there are some countries, Ireland being one, which have made considerable play of their low tax environment, and that's going to be a bigger change for them than it is for the UK. So there is quite a lot of work to be done, but it is significant.
Well, that was the NatWest Chairman Howard Davies speaking to us earlier about the G7 tax deal. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Qantas has asked Australian authorities for details of a report which suggests it has been infiltrated by organised gangs importing drugs. Local media say the report found as many as 150 of the airline's employees could be linked to organised crime. Qantas calls the claims disturbing and says it follows government vetting procedures. Now, a consortium of private equity firms has reached an agreement to buy Medline Industries in one of the biggest leveraged buyouts of all time. Sources say Blackstone, Carlyle Group and Hellman & Friedman will take a majority stake in the medical supply company in a deal valued at more than $30 billion. Singapore's GIC will also invest. Bloomberg has learned that KKR is close to reaching an agreement to buy Atlantic Aviation from Macquarie Infrastructure. The deal could value the airport services company at about $4.5 billion, including debt. Atlantic Aviation offers hangar space, aircraft maintenance, and other services. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Now, Armin Laschet boosts his chances of succeeding Angela Merkel as German Chancellor. The CDU party has secured a decisive victory in the country's poorest state. The win in Saxony-Anhalt gets his campaign back on track after his leadership of the CDU got off to a rocky start. Well, joining us now is Berenberg's chief economist, Holger Schmieding. Holger, great to speak to you. I know you're a great student of German politics and the CDU. So what are the chances that Mr. Laschet becomes Chancellor at this point?
Mr. Laschet will likely be the next German chancellor. I think he has a probability of, say, 55% of making it. The Greens still have a chance. Their leader, Annalena Baerbock, I would say 40% probability of being the next chancellor. And there is a residual 5% for the SPD candidate, the current finance minister Scholz. But Armin Laschet is ahead, and yesterday's state election result will probably help him to unite the CDU and its Bavarian sister, the CSU, behind him for what will be an interesting, vigorous campaign in which the CDU and Laschet will likely prevail in the end.
Holger, if there's anything that actually Mr. Laschet can learn from the mistakes in the early days, what are they? I mean, I keep on hearing, he's not the most charismatic. It's not, maybe he can't get through or cut through to the voters like Angela Merkel did. Will he change in the way he communicates, or can he do anything about it?
Well, I don't think he really made that many mistakes in the early days. What bogged him in the early days was the hype about the Greens and their leader, Annalena Baerbock. There wasn't much he could do about that. And what we now have as a situation is that the Greens, who briefly surged to the top of opinion polls after picking Annalena Baerbock in mid-April, that the Greens are coming under much more scrutiny. What do they actually stand for? Beyond the lofty goal of stopping climate change, how do they want to achieve it? It is now much more a debate about the ways and means how to get there. Almost everybody agrees, including the CDU, that more needs to be done to stop climate change. But in the debate about how to actually get there, the executive experience of both Mr. Laschet and of the CDU in general counts significantly against the Greens, which have much less experience with that. And as a result, the Greens have been a bit deflated in the debate and in the vote yesterday.
Holger, vaccinations, of course, are crucial. We saw it here in the UK. If people get vaccinated and can go back to normal, it can be a very big boost for the party that has, of course, control at the moment. How's it going in Germany? After, it feels like, sitting in London, after being behind, actually the inroad has been quite significant, and it could be even better than what we're seeing here in the UK in terms of vaccinated population.
Well, the vaccination rate in the UK has been higher and is still higher, largely because the UK has imported a lot of vaccines from the EU without exporting any noteworthy amount back. So in a way, thanks to the generosity of the EU in exporting vaccines, the UK has been ahead. But what we are seeing is that the EU is catching up. It is still behind in vaccination. But we are currently at a situation where the infections rate, the number of recorded new infections per day in the UK has risen, whereas in the EU it keeps falling, and in the Eurozone and the UK the infections rate is now roughly the same, with the trend being adverse in the UK. In short, what we are having is on the European continent, after a slow start to the vaccination campaign, significant progress, with Germany being among the better performing countries in the EU. And that will, of course, help to dispel some of the anger against, well, all the restrictions that has been feeding a bit into support for the far-right AfD, which, with vaccination progress and the COVID situation getting very much under control, knock on wood for the time being in Germany, the AfD did less well in Saxony-Anhalt, the right-wingers, than expected, partly because